financial reports, your financial statements. This will go for about an hour. I expect to have about 40 minutes of presentation, and then we'll have an opportunity for questions and answers. So here's a little bit of information about me. My company is Blackerby Associates. I'm a consultant with ADOT, their Business Engagement and Compliance Office, and I've been working with DVEs for over 3 years now, primarily in the area of financial management, strategic planning, and marketing. In the last 10 years, I've worked with over 800 entrepreneurs, primarily in training programs and some direct consulting. I have a master's degree from the University of Texas, Oakham Horns, and a bachelor's degree from Brown University. Before we get into this, I do want to make sure everybody is aware of the free Financial Services Handbook for Small and Disadvantaged Businesses. We published it just last November. It addresses financing, both lenders and different kinds of lenders, and borrowing, insurance, liability insurance, errors and omissions insurance, workers' compensation, and health insurance. It addresses bonding, license bonds, performance bonds, and bid bonds. And it comes in both English and Spanish versions. It's about a 20-page book, and it's available for free download. There's the real address there at a.dob.com, or excuse me, a.dbe.com, and that long URL there. Or you can simply go to http://financialservice or FinServices. And when you enter that bit.ly address, you have to enter the capital F and the capital S. It is case sensitive. So that's a shortened URL that takes you directly to the financial handbook, both in English and in Spanish. Like I said, that's a free download. A couple of rules to live by. First of all, CIK, cash is king. So cash is the fuel that runs your business, and just like when your car runs out of gasoline, what happens? Your car stops. When your business runs out of cash, what happens? Your business stops. And a related concept is DROOM, don't run out of money. So money is kind of more broadly defined than cash. Money could be credit, loans, line of credit, investment capital, additional contribution, whatever. But managing the cash, making sure that you don't run out of money, is one of the 3 responsibilities that a CEO has that a CEO cannot delegate. It's only the CEO who has the ultimate responsibility to make sure that the business has money in it. So if you're a CEO, make sure that that's number one of the top 3 things that you do. As they say, incur no overhead before it's time. Overhead is one of those things that really helps to keep a business down. So be very careful about all of your overhead, and we'll talk about just what overhead is in a few seconds. Now today we're going to talk about basic financial statements. We're going to emphasize a little time on the balance sheet and on the profit and loss statement, also called the P&L, or sometimes called the income statement. But these are the 2 primary financial statements that we're going to talk about today. But wait, there is more. Now, there is a 3rd financial statement, a cash flow statement. But this is only necessary for a business that uses accrual-based accounting. Most of you, I hope, are using cash-based accounting, unless you are a larger business, in which case you may be using accrual-based accounting. And if you do use accrual-based accounting, then you need to use a cash flow statement. We can talk very briefly about that toward the end of the program. So this is the balance sheet. This is a basic look at what a balance sheet looks like. And we want to talk, first of all, about the date at the top. So it says as of, and there's a date. So a balance sheet is as of a given date. Sometimes it's the end of a month, sometimes the end of a quarter, March 31st coming up is the end of the quarter, sometimes the end of the year, December 31st. But it's a snapshot in time. It's good on that day, and any later day, it may be a completely different looking balance sheet. So it's only good on that particular day. It's a very clear snapshot of the condition of your business. Now, when we look at the balance sheet, we see there are two sides. On the one side, there's assets, and on the other side, there's liabilities and equity. And we're going to talk first about assets. Assets are what you own, O-W-N. So the major categories of assets includes cash and equivalents. That would be not just cash, but bank deposits. If you have a certificate of a deposit, or you have anything that is equivalent to cash or convertible to cash, that goes into that category. You may also have accounts receivable. That's money that people owe to you. So you own those receivables. Those are assets. So anybody who owes you money as of the date of the balance sheet goes into the account receivable. You may have billed a prime contractor, and that prime contractor hasn't paid you yet, but nevertheless, that is your account receivable, and that is an asset. You may have other short-term assets. You may have advanced an employee some money on a short-term basis, or you may have other people who owe you money for various reasons. You may have inventory. Depending on what kind of business you have, you may have a pile of gravel, could be inventory. If you are a landscaper, you may have a bunch of plants. That would be inventory. If you're a print shop, you have paper, ink, toner, those sorts of things. Those all go into your inventory. Inventory is goods that you hold for sale to customers, which is different than your plant and equipment. Plant and equipment may include if you own the building that you occupy, or you have equipment, a dump truck, a backhoe, various kinds of equipment. Generally here we're talking about large equipment, capital equipment, stuff that's generally expected to last 3 years or longer. Some say 1 year or longer, some say 3 years or longer, but this is usually capital equipment. Now, we want to record that plant and equipment originally at the cost basis for that plant and equipment, but we're also going to recognize the depreciation of that plant and equipment. So we subtract out the accumulated depreciation. Depreciation is the loss in value of an asset just as a result of time. So everybody's pretty familiar with the fact that when you buy a car, that car depreciates every year, and usually after about 5 or 6 years, it is fully depreciated and has basically a value of 0, or maybe a scrap value of about $1,500. That's certainly what my car is worth according to the dealers. So that's all they're willing to give me on a trade-in, so I've depreciated virtually all of the value of that car since I bought it new in 2004. But other things also depreciate. So a building depreciates, your dump truck depreciates, your backhoe depreciates. All of those capital equipment items depreciate over time. So we net out the accumulated depreciation from the plant and equipment. And then there may be other long-term assets. You may have loaned money out to somebody on a long-term. You may have other investments that the company has made that are long-term investments, stocks or bonds, those sorts of things. That could be other assets that you own, and all of that adds up to total assets. Now, we have a couple of questions about assets. First, somebody asked, what is cash equivalents? What are equivalents? So those are things that are readily convertible to cash, like a certificate of deposit, for example, but are not exactly cash. They may be treasury bonds or treasury notes, things for which there's a ready market and you could easily convert them to cash. Another question is there a formula to depreciate equipment? There are a variety of formulas, and we're not going to get into all the details of different depreciation formulas, but the Internal Revenue Service recognizes several different formulas. You can have accelerated depreciation and double accelerated depreciation, and all kinds. You can have straight line depreciation, which is just the same percentage taken each year. You can look up depreciation on the irs.gov website, and I think they'll have a big white paper devoted to different depreciation formulas that they recognize. Thank you for those questions. So now let's take a look at liabilities on the right side of the screen there. Liabilities are what I owe, O-W-E. So assets are what I own, liabilities are what I owe. Try to make it pretty simple here. So the number one kind of liability is accounts payable. So again, we're at the end of the month as of a certain date, and maybe you haven't yet paid your electric bill, or you haven't paid the rent for next month, or you haven't paid your employees because payday's not till the next day. So those are all accounts payable. They're debts that you owe to other people. You recognize those debts, but you haven't yet paid them. You may have other short-term debts. So you may have borrowed short-term money from a bank, or from a family member, or from yourself, for example. The business may have borrowed money short-term from yourself. Those are also liabilities. You owe them. You in turn to pay them back. Short-term debts generally considered to be debts that are due in 1 year or less. You may also have long-term debts. So this could be a bank loan. Typical SBA bank loan, SBA guaranteed bank loan might be 7 years, and so that would be a long-term debt. Now there are other categories of liabilities, but these are sort of the main categories that you may encounter. And so you add up your accounts payable, your short-term debts, and your long-term debts, and you get total liabilities. The other side, the other category here is called equity. And equity has two primary categories. There may be some other categories, but these are the primary ones that you will encounter. The first one is called investors' capital. So when you started your business, you went down to the bank to open a bank account for your business, and the bank said, okay, give me $100 to open this bank account with. And so you wrote out a personal check generally and deposited it in that bank account for the company. That's your initial investor's capital. You invested that $100 into your business. And from time to time, you may have invested additional capital into your business. If the business needed some more money, you may have given that business more money. And sometimes you may recognize that as a debt that the business will pay you back at some time in the future, or you may recognize it as an additional capital investment that you contributed to the business. You may have also, along the line, attracted additional investors, other partners, and maybe you ask them to put more money into the business to buy a portion of the business from you. And so if you picked up a partner and that partner wanted to own 25% of the business, and you said, okay, give me $25,000 because I think my business is worth $100,000. So give me $25,000 as your investor's capital, and that goes into equity. So every investor has a capital account within the equity, and you add up all of the investors' capital accounts, and that's your total investor's capital. And we have a question, does the owner's equity include money invested by the owner in cash? Yes, it does, if you consider that an investment rather than a loan. So you have to think about, am I loaning the money to the business, or am I investing money in the business? And if you're investing it, then it goes into investors' capital. The other major category in equity is retained earnings. These are the profits that you've earned in previous years that you have left in the business. So if you take those earnings out as a dividend or as a draw, then you reduce those retained earnings because you're taking them out of the business. But to the degree that you leave those retained earnings in the business, that adds to equity. So, like I say, there are other categories of equity, but these are the primary ones that you'll encounter. So you add investors' capital and retained earnings to get total equity. Then you add your liabilities to your equity, and you get what's called liabilities plus equity. Pretty easy. But the key thing that makes this a balance sheet is that your total assets equals your liabilities and equity. Those two numbers will always be in balance. And if you think about this, so you take your assets and you subtract your liabilities, and what's left is your equity. Some people call that your net worth of your company or the total value of your company. So what you own less what you owe is what your equity is in the business. And while mathematically that's true, the fact is that you don't figure out what your equity is by subtracting liabilities from assets. In fact, you build up the equity with investors' capital and retained earnings, so that in all cases, A equals L plus E. Assets equals liabilities plus equity. This is called the basic accounting formula. Assets equals liabilities plus equity. It always is true. And that's why they call it a balance sheet. So the left side of the sheet matches the right side of the sheet. Assets match liabilities plus equity. So let's think about a couple of different transactions and see how that affects the balance sheet. So let me get my drawing tool here, arrow, there we go. So let's say that we buy a new pickup truck. That pickup truck costs $30,000. And we go ahead and pay cash for it because we've got the cash in the cash account. What is the transaction? How does that transaction affect our balance sheet? Well, the number one thing that happens is that cash and cash equivalents goes down by $30,000. The other thing is that plant and equipment goes up by $30,000. So the total assets don't change at all. Cash goes down by $30,000. Plant and equipment goes up by $30,000. Total assets doesn't change. We're basically just exchanging one form of an asset, cash, into another form of an asset, plant and equipment, which represents that pickup truck. So total assets still equals liabilities plus equity. Let's take a different approach. Let's say that we finance that truck. Maybe we put 10% down, and we finance the rest of it in a long-term note, call it a 5-year note. So what happens here? In that case, cash and equivalents goes down by $3,000. We put 10% down on a $30,000 truck, so cash and equivalents goes down by $3,000. Plant and equipment goes up by the value of the truck, which is $30,000. So our total assets then goes up by $27,000. That is, the plant and equipment less the cash and equivalents is $27,000. But is that all that happens? No. In addition, we have long-term debt that increased by $27,000. We borrowed $27,000. We created a long-term debt. So liabilities went up by $27,000. Assets went down by $27,000. So again, liabilities and equity equals total assets. The formula, A equals L plus E, still holds true. So we do have a question here about what happens if you lose money The loss will be negative equity, right? Well, if you lose money in 1 year, then your retained earnings actually goes down by the amount of the loss, and so your total equity also will go down. Yes, it is a reduction in your equity if you lose money in 1 year. So that's a really good question. Yes, as your retained earnings change, then so does your equity. So let's move on now. Turn off my drawing tools. I want to talk about two other intangible assets, what they call intangible assets. Now, these do not show up on your balance sheet, but they are intellectual property, what we call know-how, and your brand value or goodwill. You know who, that is, people know who you are. So your intellectual property may be the fact that you are the best at understanding how your business works, that you have methods for doing what you do that other competitors may not have. That's intellectual property. And you can protect that intellectual property by copyright or a patent or a trade secret. All of those are various ways to protect your intellectual property. But intellectual property is an asset, and we need to recognize it as an asset, though it does not show up on our balance sheet. The other thing is brand value, or what they call goodwill. So people know who you are. This is your reputation in business, and we need to work very carefully to preserve our reputation as well. So that means we need to pay our bills on time. We need to have straightforward, honest communications with vendors and with subcontractors and with prime contractors. We need to have all of those basic good business practices that everybody knows what they are. Now, these don't show up as balance sheet assets, but if they did show up as a balance sheet asset, they would also be balanced by an increase in your equity. That is, these are things that that are the value of your company, equity value in your company. So we always maintain that basic accounting formula, A equals L plus E, assets equals liabilities plus equity. Now we're going to talk a minute about the P&L, the profit and loss statement, also called the income statement sometimes. So you may see the income statement. That's what this means. It means your profit and loss statement. Now the first thing we want to recognize with the profit and loss statement is that it has two dates. It covers a period from one date to another date, from January 1st to January 31st if it's a monthly P&L. From January 1st to March 31st if it's a quarterly P&L, or from January 1st to December 31st if it's an annual P&L. But it always has two dates, from and to. It covers a period. So unlike the balance sheet, which is really much more like a photograph, some people say the P&L is more like a movie. So it shows what happened over a given period of time. Now, for those of you who watch CNBC and listen to David Faber from time to time, he'll talk about the top line. And the top line is your gross sales. And it's called the top line because on your P&L, it's the top line. It's the first thing that you come to, gross sales. So how much revenue did you bring in during the period covered by the profit and loss statement? So from that, you then subtract your cost of goods sold or cost of services sold. For those of you who are in the goods business, then you're going to be having cost of goods sold But if you're like me, I'm a consultant, so all I sell is services. I don't sell goods. So I have cost of services sold. They're very similar kinds of concepts, but they only apply to different kinds of businesses. So these are what they call variable costs. Okay, normal operation. There we go. Variable costs. So these are costs that you only incur when you have a sale. So if it's cost of goods sold, then maybe if you got a contract, say you got a contract for $100,000 to haul dirt away from a highway project. So your cost of goods sold may be the cost of operating your dump truck, including the fuel, maybe the depreciation on that dump truck, the mileage that account for repairs and maintenance of that truck and all the other costs of that truck, plus maybe the driver's time for that truck. All these are variable costs, and you wouldn't incur these costs unless you had that contract to haul the dirt away. They also include the cost of disposing of the dirt if you have to pay a dump fee. So the cost of goods sold, cost of services sold, is the cost of labor and materials, both labor and materials, that are associated with achieving those gross sales. So once you subtract out the cost of goods sold or the cost of services sold from your gross sales, you wind up with gross profit. Somebody said, employee wages, are these cost of goods sold or expense? So it depends. Some employee wages may be cost of goods sold, some may not. Some may be expenses. If they are directly related to the delivery of the sales, then they would be cost of goods sold or cost of services sold. So for example, if you have a salesperson and you pay that person a commission, that commission wouldn't be incurred unless you had the sale. So that's part of cost of goods sold. On the other hand, if you have labor that you only pay when they're doing work on projects, then that would be a cost of goods sold or cost of services sold. If they have other duties, then that part of their time may be an expense instead of cost of goods sold. That may be more clear when we start talking about expenses. So we take our gross sales and we subtract out the cost of goods sold or the cost of services sold, and we get gross profit. Now we use the symbol pi to represent the word profit. So G pi is representing gross profit. Now when we have a gross profit, we can also calculate a gross margin. So the gross margin then is the gross profit divided by the gross sales times 100 to make it a percentage, and that's your margin. Now, hopefully your margins are pretty high at this point. So you generally want to make sure that your gross margin is at least 50%, so that of your sales, half of your sales at least goes to gross profit. This is the percentage of your sales that goes to gross profit. That's your gross margin. So easy calculation is gross profit divided by gross sales times 100%. So we're going to talk some more about what those expenses are and how they differ from cost of goods sold in a minute. Now, another term for gross profit is called contribution. And it's called contribution because that's the amount, that gross profit is what you have to work with basically to meet all of your expenses. So when we talk about expenses, we generally break them into three sort of master categories: selling expenses, general expenses, and administrative expenses. So let's talk about selling expenses. So this is all your advertising and marketing. Could be signage, could be your business cards, could be the cost of the signage that you put on the side of your truck, could be your website, could be your listing in the yellow pages that you pay for. So those are all selling expenses, anything that has to do with advertising, marketing, and if you have a salesperson, then it could be the base salary of that salesperson. The commissions, of course, are a variable cost, and they go up under cost of goods sold or cost of services sold. But your selling expenses include the base salary of that salesperson. Second is then your general expenses. General expenses are what we generally call overhead. So this may be rent, utilities, electric, water, telephone, cell phone, all of those expenses that are pretty much fixed over time. Could be also supplies, miscellaneous stuff that you have to maintain, that you have to spend from time to time. So those are all general expenses. Think about general expenses as overhead. And the third category then is administrative expenses. Now, administrative expenses are also kind of like overhead, except the key distinction is that administrative expenses have to do with running the company, whereas general expenses are often associated with this is about delivering products and services to customers and clients. Administrative expenses are about running the company rather than about delivering products and services to customers and clients. So your administrative expenses are certainly going to include attorney fees. So every time you have a contract looked over by an attorney, that would be an administrative expense. Your CPA who does your taxes, those are administrative expenses. You may have a bookkeeper who keeps your books on a monthly basis. That would be an administrative expense. Your secretary or your receptionist would be an administrative expense. They're really more about managing the business, including the CEO's salary. So if you are the CEO and you take a salary from your company, that would be an administrative expense. That's the cost of managing the company rather than delivering products and services to your customers. So these expenses, these three categories of expenses, selling, general, and administrative, or SG&A, they're often called, these are also called fixed costs, as contrasted with the cost of goods sold and cost of services sold, which are variable costs. Variable costs you only incur when you have a sale, but these fixed costs, so-called fixed costs, SG&A, you incur those expenses whether you make any sales or not. I'm sure everybody's very familiar with that. So you have to keep up sales in order to be able to have a gross profit, which contributes to meeting your SG&A expenses. Now, why do we keep these in these main big categories? And the reason is because the selling expenses have different levels of control. You have complete control over how much you spend in selling expenses. So you can choose not to list your business in the yellow pages. You can choose not to take your prime contractor to lunch, which would be a selling expense. You can choose not to host your website. You can do all sorts of things. Of course, now, if you cut your selling expenses down to zero, then eventually your gross sales might start to fall as well. So it's not a very good business decision, but you do have complete control over how much you spend in selling expenses. On the other hand, your general expenses are generally going to be fixed. Now, you may be able to negotiate a lower rent from your landlord. You may be able to get a less expensive cell phone plan. You may be able to be more efficient about how you use electricity and keep your electrical bill down, all of those sorts of things. So they're not exactly fixed, but they are pretty well set in stone, and they're not going to vary a whole lot month to month. They're going to be pretty much the same. You're always looking for economies, but these are pretty well fixed expenses. Your administrative expense, on the other hand, is somewhere in between the selling expenses, which are completely under your control, and the general expenses, which are pretty much fixed. So you can choose not to have a secretary. You can choose not to consult your attorney on every single contract that comes up, but only on the most complex contracts. You may choose to use an enrolled agent to do your taxes instead of a CPA. That may have some complications later on, but nevertheless, you have a little bit more control over the administrative expenses than you have over the general expenses, but not so much control as you have over the selling expenses. So they're sort of in between. But wait, my QuickBooks doesn't categorize expenses into selling, general, and administrative, and you're absolutely right. So one of the things you can do if you want with your QuickBooks is create 3 new sort of mega categories for selling, general, and administrative expenses, and then make all of your other expense categories subcategories within those selling, general, and administrative expenses. That's an option, and sometimes that's a good way. Then you can get subtotals on your P&L report for selling, general, and administrative, and you can look at your P&L and try to manage and say, okay, here's my selling expenses. I have control over that. Here's how much of my expenses are not really controllable because they're fixed in the general category. And then here are my administrative expenses. Can I find some economies in my administrative expenses? So that's an option that you might have. Somebody asked, what is the category of professional liability and general liability insurance? Those are generally going to be general expenses. That's part of your overhead. Good question. So you take your gross profit up above, and let's get my drawing tool here. Take your gross profit, and you subtract from that your selling, general, and administrative expenses, and you wind up with what's called an operating profit. And now another term for that operating profit is EBITDA, earnings before interest, taxes, depreciation, and amortization. If you listen to CNBC and you hear David Faber always talking about EBITDA, then that's what he's talking about, is this operating profit. Now, the operating profit is not how much money you get to put in your pocket at the end of the period. The operating profit, though, tells you whether the operations of your business are being profitable or not. So this is all about what the services and products that you provide to your customer. Are you really making money on the operations of your business? That's your operating profit. And anytime you have an operating profit, then you also have an operating margin. So again, just like the gross margin, you're going to calculate your operating margin as a percentage, your operating profit as a percentage of your gross sales. So operating profit, or OPI, here, divided by your gross sales up here, times 100 to make it a percentage, that is your operating margin. And you hope your operating margin is in the neighborhood of 15 or 20% if you are, in fact, a good operating company. Now, there are these other things, then, which we call interest, taxes, depreciation, and amortization. So if your EBITDA is earnings before those 4 things, then we have to take into account those 4 things, interest, taxes, depreciation, and amortization. And those may be pluses, they may be minuses. You may be earning interest, you may be paying interest. You may get a tax refund, you may be paying more taxes. But these things, depreciation and amortization, interest and taxes, they really don't have anything to do with the operating profit of your company. They have more to do with how you play the financial game. So interest has got to do with whether you borrow money to buy your equipment, or you lease your equipment, or you pay cash for it. Your taxes, well, everybody knows how much taxes is really a game, and so how you play the tax game can affect how much money you actually generate, plus or minus, to your operating profit. Depreciation, again, whether you buy your equipment, you lease it, you own it, however you pay for it, that'll affect your depreciation. There are multiple formulas for depreciation, and how you play that game will affect how much money you actually earn. Amortization is a whole other concept. So you take your operating profit here. Yep. Don't have the arrow again. Arrow. So you take your operating profit and you add and subtract the interest, taxes, depreciation, and amortization to get your net profit. Now that's the money that you can actually put in your pocket. That's the money that you actually earn in your business. So when you have a net profit, you can also have a net margin. So again, the net profit, or NPI, right here, divided by your gross sales, which is up here, that's the percentage of your sales that goes into net profit. You multiply by 100 to make it a percentage, but that's your net margin. And hopefully your net margin is a positive number if you're actually making money. And a good, healthy company will have a net profit of 10, 15%, sometimes even 20%. So the better your net margin, the better off you're going to be. So let's move on. The cash flow statement. So as we said before, this also has a from and a to date. And like we said before, this is only used if you use accrual-based accounting. Now, I'm not going to get into it too deeply here, but if you use accrual-based accounting, then you recognize income when you sign a contract, and you recognize expenses when you incur them rather than when you pay them. So if you have a $100,000 contract to haul dirt away from a highway project, then you would recognize that $100,000 all when you actually sign the contract, and then you recognize the expenses as you incur them, even though you may not actually pay them. Now, what happens is that when you use an accrual-based accounting system, it's hard to tell how much money you actually have in the bank. So the cash flow statement basically reconciles the accrual-based accounting system to the amount of money in your bank. So it has to do with sources and uses of cash due to operations, sources and uses of cash due to financing, and sources and uses of cash due to investing. You add in your beginning cash, and that gives you your ending cash, and that should be the amount of money that's actually in your checking account at the end of the period. So we have another question here. Can you please summarize again how the gross margin, operating margin, and net margin percentages give ideas to CEO about how the business is doing? Yes, we can do that. So this is our P&L that shows the 3 different levels of margins. So we have the gross margin, the operating margin, and the net margin. So each one is a percentage of what percentage of your gross sales went to gross profit. Now, hopefully that's going to be at least 50%, depending on what kind of business. In my business, since I don't consider my salary, I get paid every month whether I have any gross sales or not. So in my case, I consider my salary to be a general expense rather than a cost of services sold. So I need to have a gross profit in the neighborhood of 90 to 95%. But if you have an architecture and engineering firm and you pay your architects and engineers based only on the hours, the billable hours that they work, and you have enough billable hours available to keep them busy, then you're going to charge them under cost of services sold. That's going to reduce your gross profit then hopefully to a level that still allows you to generate a contribution that will cover your selling, general, and administrative costs, your fixed costs. So it depends on what your business is and what your business model is and how you figure your cost of goods sold to generate your gross profit. So the gross margin then is the percentage of gross sales that go to gross profits. So it's your gross profits divided by your gross sales times 100. Your operating profit then is your gross profit less your SG&A or fixed expenses. So your operating margin is your operating profit divided by your gross sales. What percentage of your gross sales goes to your operating profit? For every dollar in gross sales, how many cents go to operating profit? So that's what your operating margin is. And hopefully your operating profit is somewhere in the neighborhood of 10, 15, 20%, maybe 25%. Again, depending on your kind of business. So grocery stores, which are notorious for having very slim gross margins, have very slim operating margins. The only way they make money is if they sell a lot of stuff, and so while they have a small margin, they make a lot of actual money because they have a lot of actual sales. But for most of us, we hope that this operating profit is in the neighborhood of 10 to 20% or more. Then the net profit, this is how much money you have actually to put in your pocket at the end of the year. So your operating profit less or added to your interest, taxes, depreciation, and amortization. That's your net profit, and so you have a net margin. Hopefully your net margin is at least 10%. Otherwise, you may do better by investing your money in treasury bills, for example. So it depends on how you invest your money, how much margin you get. This is basically the return that you get on your business as a percentage. I hope that addressed the question. Any other questions? We can talk about, we've got about 10 minutes left. We can talk about whatever you want to talk about. I don't hear any other questions. Can you put your questions in the chat window at the bottom, please? So does taxes include both federal taxes and payroll taxes? That's a good question. No, the taxes here includes only your income taxes. Though it may also include your property taxes. But you want to put your payroll taxes in wherever the associated employees are. So if it's a commission and you pay payroll taxes on the commission, then it would go under cost of goods sold or cost of services sold. If it's a selling expense, then for your salesperson, then you put the associated payroll taxes in your selling expenses. If it's general expenses for employees who are considered overhead employees for perhaps maintenance or repairs or those sorts of things, then you put the associated payroll taxes there. Your CEO is an administrative expense, and so you would put the associated payroll taxes where you put the salaries, which is under administrative expense for that kind of employee. Good question. Okay. Somebody asked, what is amortization? So amortization really has mostly to do with a specific accounting concept, mostly to do with the oil and gas industry, the extraction industries. Most of you won't encounter that kind of thing, but it is a technical term, and it's part of what makes up EBITDA. So we put it in, but that's something you generally won't encounter. Okay, so we had a question about the balance sheet. Let's see if we can't figure that out. Let me, previous. Okay, so question about the balance sheet. Under liabilities, do we put all the bills due in a month or just the unpaid ones up to the date of the balance sheet? So your accounts payable right here is just your unpaid bills that you're going to pay next month, but you haven't paid them yet. So you've already gotten a bill for your telephone or your cell phone, but it's not due until the 8th of the following month, and so that's an account payable. You've already gotten your electric bill, but you haven't paid it yet because it's not due till the 15th of next month, so that's an account payable. So it's just the unpaid bills as of the date of the balance sheet. Hope that answered that question. So somebody asked about how do you value intellectual property and goodwill? That's, a topic for a long seminar. The value, that's why it's not really carried on your balance sheet. It's called an intangible asset because it's hard to figure out exactly what that value is. Nevertheless, we recognize that while they don't show up on the balance sheet, those are assets of the company. And so we want to be careful to protect those assets, just as we protect our other assets. We have insurance on our cars. We have liability insurance. We have, all kinds of different ways of protecting our assets, and we want to protect our intellectual property. So if we have intellectual property that we want to protect, we can use either a copyright or a patent or a trade secret. For most of you, if you have a particular technique, you want to protect that as a trade secret. And that trade secret is a property right. And as long as you take steps to protect that trade secret, it is a property right. If somebody steals it, you can actually sue them and recover damages for stealing your trade secret, so long as you take steps to protect that trade secret. Your trade secret could be your customer list, could be your vendor list. It could be your methodologies, your procedures, your standard operating procedures. Those are all intellectual property assets that you may want to protect. Your brand value could include your trademark, but most important, it's your reputation, and you need to take steps to protect your reputation. So don't do anything that would damage that reputation. Make sure you pay your bills on time. Make sure you meet the requirements of your contracts. Make sure you deliver products and services on time as contracted. Make sure you account for your projects and you submit accurate invoices to your contractors. Those are all important elements for protecting your brand value. Again, there's no way really to assess a value to that brand value, but you know that it's there. And so it's an intangible asset that doesn't show up, but that doesn't mean you don't need to protect it. Here's a good question. When you go to the bank for a loan, what's the loan agent looking for in your P&L? Good question. So fundamentally, they're going to look at all aspects of your P&L. They're going to look at your gross margin. And if you don't show your gross margin, if you just show gross profit, they'll go in and calculate that gross margin for you. They want to make sure, and they'll compare it to other companies in that same industry, and they want to make sure that you're tracking your cost of goods sold against your gross sales. Now, important thing about tracking your cost of goods sold is that may be ways that you can bill your customers, particularly in the construction industry. That's how you set your billing rates, basically. So you want to pay very close attention. And I noticed at the last regional conference, there was an accountant from Price Kong who talked about exactly this, how to calculate your cost of goods sold and your cost of services sold. I expect that workshop will be repeated at future regional conferences, so I encourage you to attend those regional conferences when they're offered. So they're looking at your gross margin. They're also looking at your operating profit. They want to know that you're actually keeping your SG&A expenses, those fixed expenses, you're keeping them down. They want to know that your operations are actually making a profit, and that profit is going to be big enough to cover the service, the loan service on the debt that you're trying to borrow. So if you're trying to borrow $100,000 to buy a new piece of excavation equipment, for example, they want to know that you're generating enough operating margin, that you're generating enough profits that you can pay the debt service on that loan. They're also looking at your net margin. They want to make sure that the actual money that your company is generating will in fact pay the debt service on that loan, that you have, they call loan coverage. And in fact, they're going to want to make sure that you have probably more than is required to cover the debt service on the loan. They want a loan coverage multiple of maybe 1.5, maybe even 2. So they want to make sure that you are able to cover the debt and have additional profit on top of that. So those are all important elements that a bank is going to look at when they consider making you a loan. Let's see, AP and short-term debts, accounts payable and short-term debts. So an account payable is a regular account that you may have due that you have to pay, whereas a short-term debt would be like a note that you owe to perhaps a bank. You may be in the final year of a loan, or you may have taken out a short-term loan from a bank. That would be a short-term debt, whereas an account payable is something that's really got to be paid right away, probably next month. Where your credit card debts go on your balance sheet, so your minimum payment certainly for the next month would be an account payable. If you really plan to use that credit card debt and you plan to maintain a balance of debt on that, then that may be a short-term debt. We hope that's a short-term because you don't want to maintain those high interest costs for a long time. What do you call your time if time is directly related to income in one person's business that does only bidding for income? I'm not sure I understand that real clearly, but if you're bidding, that's really a cost of selling. So it's not a cost of delivering. So that would be one of your selling expenses, which makes more sense, monthly or quarterly balance sheets and P&Ls. I think you should generate a balance sheet, a P&L monthly. It's valuable to look at them quarterly as well because that gives you a better sense of what the trend is, but you need to track it on a monthly basis. They're all tools, and you need to use all of those tools to manage your business well. What's the best method to write off a new company vehicle? Well, this has to do primarily with depreciation. And so you have to look at all the different depreciation formulas available and decide for you which is the best one. If I have cash, shall I use it to pay off debts, or shall I keep it in the bank and apply for a loan to pay the debts? So if you have some debts, you may want to refinance those debts. If they're high interest, it would be better to have a lower interest loan, but you can't really get an SBA loan to refinance existing debt unless you can really demonstrate that it's a benefit to the business. There's some very tricky rules in the SBA loans about refinancing existing debt. So again, I would talk to your banker about that. That's a question that your banker would want to look at your P&L, look at your balance sheet, and help you, give you some guidance on whether you use your cash to pay off debt or use your cash to keep and then refinance your debt. But remember, you always want to have a healthy reserve of cash, kicked room. You want to, cash is king. Don't run out of money. As a professional services firm, what's the one thing that you would do to look good on paper? You keep more cash on the books. Cash is king. Don't run out of money. So having some cash available on a regular basis, because you never know what's going to happen. So we run a little bit over, so I've got 3 minutes after 10. I want to thank you all for your participation. Thank you for your excellent questions. Thank you for your attention. And we will record this. We are recording this program, and we will make it available on the website later today, hopefully, maybe tomorrow. I will send you all an email as soon as it's available and let you know exactly how to access it. Thank you for your participation, and I look forward to next Friday. Next webinar will be on Friday, April 4th is the first Friday, so that'll be our next Friday Fundamentals webinar. Look for it. We'll talk about more advanced financial management issues like break-even point, cash flow management, those sorts of things. So we'll look forward to seeing you next month for Friday Fundamentals. Thank you very much.